Welcome to The Explainer. Today, we're putting on our financial detective hats to solve a really tricky mystery. How much is a company actually worth when its money speaks more than one language? Let's get into it.
All right, here's our game plan. First, we'll lay out the puzzle itself. Then, we're going to crack the code that connects different currencies. After that, we'll look at two separate paths that, believe it or not, lead to the exact same answer. Then, we'll see what happens when the accounting rules throw a wrench in the works. And finally, we'll figure out how investors can tame these wild, unpredictable currencies.
Okay, first things first, let's really frame the central mystery we're trying to solve here. This is a challenge that every single company faces the moment its business crosses a border. So this is the big question, right? You've got a company. Maybe it builds its products in one country, sells them in another, and its investors are sitting in a totally different one. Each of those places has its own money, its own inflation, its own interest rates. So how on earth you nail down one single, solid number for what that company is worth? This right here lays out the problem perfectly. Up top, you've got the company's world. It's cash, it's inflation, it's interest rates, all in Swiss francs. But down below, you've got the investor's world, and it's a totally different set of numbers, all in euros. And that thing connecting them, that's the foreign exchange rate. Our whole job is to figure out a value that makes sense on both sides of that bridge. So to solve this thing, we have to start by understanding the clues that link these economies together. There's actually a hidden logic, a kind of code, that connects all these different currencies, and we're about to crack it.
The very first clue is something called the real interest rate. Look, think about it like this. If your bank account pays you 5% interest for the year, but inflation is at 3%, your actual buying power only went up by about 2%. That 2%, that's your real interest rate. It's the only number that tells you how much your money is really growing.
And here's how the pros connect all the dots. This formula shows that the rate a bank advertises, the nominal rate, isn't just the real rate plus inflation. Nope, they actually compound on each other. It's a small detail, but it's an absolutely crucial piece of the code we're trying to crack. And here's a perfect example of that in action. You got a 3% real return, and you combine it with 1% inflation. You don't get a flat 4%. You get 4.03%. Now that little tiny difference, that's the compounding effect. And it proves that a country's inflation and its interest rates are basically locked together mathematically. So this is where it all comes together. Because interest rates and inflation are linked inside a country, they also create a predictable link between countries. To put it simply, money tends to flow where it can get a higher real return, and that movement is what shifts the exchange rate. This relationship is the master key that lets us translate a company's value from one currency to another. All right, now let's get to our two main methods for actually doing the valuation. You can think of it like a detective following two completely different trails, but both should lead to the exact same suspect. Okay, here they are, our two paths. With method one, you do all your math in the foreign currency. You project the cash flows, you figure out the value in, say, Swiss francs, and only at the very end you convert that final number back to euros. Method two is the total opposite. You convert every single future dollar or franc or whatever into euros from the get-go, and then you do the entire valuation in your home currency. So let's follow path one, and we'll use Mexican pesos as our example. We figure out the company's cost of capital, which is basically the return it needs to make its investors happy, entirely in pesos. And you can see the numbers are pretty high here, and that reflects the local market risks and inflation. This gives us a weighted average cost of capital, or WACC, of 15.2%. You can think of WACC as the minimum grade the company needs to get on its financial report card. Okay, now for path two, we're doing the exact same calculation, but now we're doing it from the perspective of an investor who thinks in euros. We've converted everything up front, and look at that. Notice how the cost of capital is way lower, a WACC of just 8.5%. That's because we're now using the interest rates and the risk levels of the Eurozone, which are just plain lower than Mexico's. And here it is, the big reveal, the solution to the whole case. It actually doesn't matter which path you take. As long as your assumptions about inflation and interest rates are consistent and you apply them correctly, both methods will lead you to the exact same valuation for the company. It's two totally different ways of doing the math, but the final answer? It's identical. But just when we think we've got it all figured out, there's a plot twist. See, the world of finance isn't just about pure math, it's also about rules. And the accounting rules, well, they aren't the same everywhere, and that can really stir things up. This chart shows you the plot twist.
The rules for translating foreign money are not one size fits all. The method a company has to use depends on two big things: how high the local inflation is and whether the company follows U.S. or international accounting standards. This means you could have two companies in the exact same high inflation country, and one might be valuing its assets at what it paid for them years ago, while the other has to adjust everything for today's prices. It's the same reality, just reported through two completely different lenses.
And this is absolutely critical, folks. This is not just some boring detail for accountants. Look at this table. Using one method, the current method, this company reports a profit of $32 million. But under the temporal method, which is required in other situations, that same company reports a profit of $56 million. That's a massive difference, and it all comes down to a change in the accounting rules.
So with all this complexity flying around, different interest rates, shifting exchange rates, conflicting accounting rules, how do investors even begin to manage all that risk? How do you tame a wild currency?
First, let's just take a second to appreciate the problem. This chart shows a currency's exchange rate over about 25 years. I mean, look at those jagged peaks and those deep, deep valleys. That, my friends, is volatility. That is risk. If you invest in a company that earns money in this currency, your returns could swing like a pendulum from one year to the next just because of the exchange rate.
And here, we see the solution in all its glory: diversification. It is the classic advice: don't put all your eggs in one basket. On the left, you've got the insane volatility of individual currencies. Argentina is over 28%. But check out the right. When you group them into a portfolio, the combined volatility plummets to just 8.2%. Why? Because the currencies don't all zig and zag at the same time. Their movements start to cancel each other out, which creates a much, much smoother ride for the investor. So what's the big takeaway from our whole investigation? Well, cross-border valuation might seem like this impossibly complex puzzle, but at its heart, it's a solvable one. It's built on consistent, logical math. And that leaves us with one final, bigger question to chew on. In a world where a company's true value can be calculated and understood in any currency, what does its nationality really even mean anymore? That's a question that defines business in our modern global economy. Thanks for joining me on this one.